Question number 24. Your audit client, Hazina Limited, is yet to finalize the financial statements for the year ended 30th of June 2023. The company recruited a new accountant who has been in the company for just 2 months. To avoid delaying the audit, the accountant has provided the following list of balances with additional information. So we are given all this additional information here. All this. Now you are told prepare an audit working schedule having 4 sections for draft of balance, adjustments, profit or loss items, and statement of financial position items. Each section should have a debit or credit columns, therefore 8 columns. So let's come and prepare that answer. Skip one line. We have details. So I get 2 of them here. I merge so that I will have the draft trial balance. And under that, I have debit and credit. Then I come here. I have adjustments. Under this, we have debit and we have credit. Then I take 2 more here. Statement of profit or loss. Do text wrap. So here we have debit or credit. This one. One also. One. One. Statement of financial position. So what you do next now, what you do, this one we can merge the whole of it up to there, and we call it audit. Audit working schedule. So chukua hizi balances hizi kuanzia tu hapa, mpaka hapa kwa suspense. Control C, come and paste them here. I should paste them here. That way. Then this one I can autofill all the way up to there. So this one I can merge. Then once again, you take these ones First of all, let me take this, ama nichukulie kuanzia hapa. And I do hii mouse yangu kimechapa. I do the text wrap. Zitoshe. Haya, sasa chukua hizi. You copy, paste them here. Now, or maybe first of all, let's format these ones. Okay, what is this now? I want to format these cells. Now, if you are where I am, say yes. If you are there, you say yes. Four more people to set. I'm waiting for 3 more people. Let me give you how many minutes? 2 minutes. 2 minutes. Ndio niendelee. Now I want to proceed. The others, I hope you will catch up. So let's now begin with the recording of the transactions where they belong. And as we did in the other question, I'll be asking where each item belongs. So ordinary share capital, debit or credit? You can be writing C for credit and D for debit. Ordinary share capital, credit or debit? Yeah, I can see that is credit. So we delete this one. Let's go to preference share capital. Where does it belong? Yeah, it's also a credit balance. Revaluation reserve. Yeah, revaluation is also credit. Retained earnings. Retained earnings, those are profits. They are also credits. Inventory is at 1st of July. So this must be, we are doing books for, have they said? Inventory on 30th of June 2023. So this must be opening stock. Good. So this one is a debit balance. Trade, naitwa nani? Trade receivables, debit. Cash at bank, debit. Trade payables, trade payables is credit. Rolling stock, credit. Sales, credit. Purchases, that's debit. Credit loss, or bad debts. That is an expense, debit. Salaries and wages. Yeah, we debit also. Insurance, they have just said insurance. That is also an expense, debit. Postage and telephone. Yeah, we debit. Right and heat. We debit. Loan stock interest paid. Yeah, we debit. Directors' emoluments. We debit. Dividends paid ordinary. Debit. Dividends preference. General expenses. Debit. Motor vehicles at cost. Debit. Accumulated depreciation. Accumulated depreciation is credit. Yeah, because it's meant to reduce this cost. Office furniture and equipment. Yeah, that's yeah. Accumulated depreciation. That is also credit. Land. Land, where does it belong? That's debit. Buildings. Debit. Accumulated depreciation for buildings. Credit. Suspense account. Now, suspense account, you cannot tell where it belongs. Cannot tell where it belongs until you balance off. Yes, JM. Until you balance off, because a suspense account is put to make sure that the trial balance balances. And it represents a figure that you are not aware where it's coming from, where it went. So you just put it there so that the trial balance balances and you proceed. But as you proceed, if you discover what you had missed, you come now and remove it. So as at now, we will seek to balance, then it will tell us whether this is debit or credit. So we come here. We say this should be equal to sum. You take these values mpaka hapa. You close the brackets, press enter and tell me the figure. Press enter and tell me the figure. So you can see now, for it to balance, this one must move out. Yeah. So that tells you that the suspense is a credit balance. The suspense is a credit balance when you autofill. So now this line I can delete or I can remove these ones. So now my trial balance is balanced. So if my trial balance is balanced, let us now go to the additional information one by one. So the suspense account relates to an issue of ordinary share capital at par. Now that suspense account, it was share capital that was issued. But was not recorded. So what we do, we will then close this suspense account. We will close it and take that money to the trial, to the what? To the share capital. So we will need to come here, debit this. We debit the suspense. So you say equals, you debit here. Then we go to the share capital here, you credit it because of this. So just a minute. The next is saying that land has been revalued upwards by 4,000. So when you revalue, you debit land so that it goes up. And then you credit the revaluation reserve. The revaluation reserve. So we will come here where we have the revaluation, this one. We credit it by 4,000. Now this one will have just to type because it is not in a cell on its own. So we are going to credit the revaluation. Then we go debit LAD. Tukuje hapa kwa LAD hapa. We say equals. We debit it there.
Mwalimu, hapa nimepitiwa ticha.
Tumesema when you revalue assets upwards, the value of that asset increases. So an increase in an asset, we debit. So that's why we are coming here to LAD, we debit. And then the corresponding credit goes to the revaluation reserve, this one. Is that okay now? Whoever had asked that question, is that okay?
It's okay, Doc.
Okay, thank you. Higher. Inventory on 30th of June amounted to 43. So this must be closing inventory. So tutakibia hapa chini tuifungulie an entry. And you remember we said closing inventory will go to the income statement as a credit and go to the statement of financial position as a debit. That is an asset. So we shall come here and say there is closing stock or closing inventory. Now this closing inventory, there is the one that is going to the statement of, ama niweke badala ya 2 lines, let's put a dash here, and we say this is going to the statement of profit or loss. Statement of profit or loss. Then the closing inventory dash, the one that is going to the statement of financial position. The statement of financial position. So the one that is going to statement of profit or loss, we will credit. We will credit. So let me go check how much that amount is. 43,150. So I come here and I credit 43,150 in the adjustments. And then I also credit it here. I also credit it in the statement of profit or loss, 43. No. This one now I need to say equals. I take this so that I start creating the audit trail. Then I come and debit here, the one that will go to the statement of financial position. So I click equals, then I click this. And then this one, nikibie nayo hapa, I debit the statement of financial position. I debit the statement of financial position. So that one we are done. Additional credit loss of 1,000 is reported, while expected credit loss is estimated at 2.5. At 2.5. So now this one is introducing two things. They are saying there is additional 1,000 and then the expected is 2,500. So this is the closing balance. And you know what we should do? What we should do, tutakuja hapa in the credit, this one, because it is an expense. Because it is an expense, we are supposed to debit. And when you debit that amount, it should be reflected in the expected credit loss. I don't know whether we had it. Ndio tujue whether it's an increase or a decrease. Did we have the expected credit loss? Hatuna. So kama hatuna, we are going to create one here. Expected credit loss. Now, this expected credit loss it is twofold. Now that we are introducing it for the first time, there is the one that is an expense, and the expense will go to the statement of profit or loss. And then we will have the expected. Credit loss that will go to the statement of financial position. So this increase, this one, we shall bring the 2,500 here. We debit, then we come and credit here. It should go as a credit. And why it's going as credit is because it will come in to reduce our receivables. This one, you could as well come and credit. You come and credit this one. Yeah, you come and credit the ipunguze. But here we have chosen to put it separately. So we complete this transaction. So I will come and debit here, this one. And I'll come and credit here, this one. Now, in so doing, that one is complete. And we have taken that this 1,000 is part of this 2,500. Because you can see, we are recording it for the first time. That's the first time we are recording the expected credit loss. Higher. Salaries and wages excludes an amount of 520 due to casual employees hired in June. So if salaries exclude an amount, that is an error of omission. So salaries being expenses, we will need to debit them. And because we have not paid, these then should be treated. These then should be treated as accrued salaries. So we will come down here where we have salaries. These ones, where are they? These ones. So in the adjustments, we debit. Nimeona ni ngapi? 520. We debit that. Then we come down here and talk of accrued salaries and wages. Now, these accrued, remember, it is supposed to go to the statement of financial position as a current liability. So we are going to credit here equals, tukibia huku juu, tuchukue hii 520. Tukue hii 520, we debit. Sorry, we credit. We are crediting it there. Then, tukuja tuimalizie hapa. We credit it there in the statement of financial position. Aha. The next transaction is where? In addition, the audit fees are estimated at 1,200. So in our draft here, I did not see audit fees. Now, if I don't see audit fees, this tells me that audit was done but never paid for. And when audit is done, that is an expense to the business. So it should go to the statement of profit or loss, where I will come and debit. So I'll say equals an amount of 1,200. Yeah, that is what happened. Now that we did not pay, this qualifies to be called accrued audit fee. Is a current liability that should go to the statement of financial position. So we credit here. And then this one, we come and debit here. Alafu sasa hapa, we come and credit. We come and credit. Kama tuko pamoja mpaka hapo, sema yes. We are together at that point. Sema yes, sema yes. Aha, Joy nimesema audit fee, now that we are not able to find it in this list. Hapa. Kuanzia hapa mpaka kwenye tulikuwa tumepewa. Zilikuwa zimefika hapo. Ni kumaanisha audit was done but never paid for and recorded. So, because audit was done, that's an expense. So, an expense is always debited. So, we bring it here and then we take it here to statement of profit or loss or income statement. And because we never paid, that's a current liability. So, it's accrued audit fee that goes to the balance sheet as a credit. Is that okay, Joy? Good, thank you. Haya. Let's proceed and address the next item. The loan stock interest paid is for half the year. So tukibia tuangalia hiyo loan stock. Iko hapa. You see here there is loan stock. 10% loan stock. Yeah, 8,000. So for the full year, it should be 800. But we are told here they paid ndio hii kwa number 77. They paid half. So we need to recognize full. We need to recognize full. And what we can do, now if we recognize, or for us to recognize it at full, we will debit. We will debit because this is an expense. So I will come here and say equals, and I can show the examiner I know how to compute it. So I will say 0.1 times I take this loan stock. Tumeiona wapi? This one. And then when I do that, because it was paid for half, I multiply by 0.5. Tell me what you're getting. Yeah, good. So that 400 should be debited there. Ndio now hii 400 plus this 400, they will give us 800. Actually, hata tunaweza iweka hapa tu ama acha, sababu hata hizi zingine I'm not completing. Hata tuende huku chini. So sasa this one is an amount not paid. So it's accrued loan stock interest. So tukuje hapa tuandike accrued loan stock interest. Now this one being a liability, it should be credited. So equals, ukibia hapa juu hii 400. And because this is a current liability, we credit it here. It's a current liability, we credit there. When we credit, we proceed. General expenses include prepaid amounts of 350. So prepaid means we have paid, but we have not used. So we have not yet incurred, and therefore it should come to reduce. It should come to reduce our what? Our expenses. So general expenses. Iko wapi general expenses? Let me see. I can either, nimeiona ndio hii. So to reduce it, we will have to credit. We will have to credit. So I will say equals 350. So you credit this one, ndio ipungue. Then tukibia hapa chini, we say now there is prepaid general expenses. And because it is prepaid, this is an asset. So we debit. Alafu sasa hii, we bring it here to the statement of financial position. Yeah. Tuende kwa huyo mwingine. Depreciation is charged as follows. So the depreciation is 30% on reducing balance for the motor vehicles. So tukuja hapa chini, tuangalie, sikuwa nimeona account ya depreciation expense. So itabidi tumefungua hapa depreciation expense. This one I can separate them. I can come here and I pick these ones, these three. Control C, kuje niziweke hapa. Alafu, yeah, already they have already indented, ishaingia ndani. But kama unataka kuindent, you can just click there, you say 1, 2, 3. The same case here, 1, 2, 3. The same case here, 1, 2, 3. Yeah. So depreciations expenses, or depreciation is an expense. So we are going to debit. So tukuje hapa kwa motor vehicles. It shall be equal to this rate here. This one, 30%. So you can click that. times, because we are told is a reducing balance, we must get the current balance as at now. So times, open the brackets, open the brackets. Let's go look for the motor vehicles, the original cost. Here we are. This one. That is the original cost. You click on it. Then you minus the accumulated depreciation at the beginning of the year, 6,300. So that gives you the net book value. Close the bracket, press enter, tell me what you're getting. Tell me what you're getting. Yeah, I can see 4020. Now this one, we are supposed to debit here and credit the, and debit the income statement, because that is an expense. And then that amount must reflect in the accumulated depreciation for the motor vehicles. So we will come and credit it. So I will come, now that I've debited here, I will come and credit here. This one. We do the same for the furniture. Equals, tukimbia hapo juu, tuangalie wanasema, sijui kama hiyo wameichukua as 10 ama ni just 10%. Let's see whether it will work. Times the straight time. So kama ni straight time, you just multiply by the original cost. The original cost of furniture. This one. So let me press enter ndio nione kama. So that means this figure here, they did not give it as a percent. So tukibia hapa tubadilishe. And you just type 0.1. Just type 0.1 there and convert it to percent hivyo. It should change now accordingly hapa chini. Ni wapi? Ndio hii. So, tunasonga tu. Tukuje kwa huyu mwingine, buildings. Buildings equals these 2%. Again, because it is, anaitwa nani? Straight line. It is a straight line method. We just come and multiply by the buildings, this one. And there is something we need to do like we did with the depreciation for the motor vehicles. So hii kwanza, tuilete hapa kwa statement of financial position, no, statement of profit or loss, as well as these 900. So these ones should be brought here on the debit so that they are recognized as expenses. Then they should go to increase the accumulated. So twende kwa accumulated ya furniture. Accumulated depreciation for furniture ndio hii. So we need to credit it. Equals, you take this. Then buildings, the same. They are accumulated here. Equals. So I hope you are following track. Tumezidebit hapa, tukadebit hapa. then tumekuja tumezicredit hapa. Haya, tukuja hapa. Estimated corporation tax is 6,500. So if it is estimated, that is the tax for the year. Now that one is not paid. Let's see whether they had also some opening balances for tax. Sioni. I cannot see it. So if I cannot see it, then that tax will be recognized as an expense. Let me use the correct name, the exact name they are using. Corporation tax. So there is corporation tax. Now, the one that is an expense is going to the statement of profit or loss. And then we will have the corporation tax. And this is the one going to the statement of financial position. So the one coming in as an expense, we debit here. The amount is 6,500. And then this one going to the SOFP is going there as a current liability. Actually, I should have baptized it or specified that this is accrued corporation tax. Sasa hii nikuja hapa niseme equals 65. Now this one, we come here and debit it. Then we come here and credit this one. So we are done with the additional information. So once you are done, you know very well, we will have something else here called the retained profit or the profit for the year. So this one we call it profit or loss for the year. And with that now we shall have the total. So this total we can have it bold. Then tunaweza anza hapa kwanza tutafute the totals. So the totals we will say here equals sum. You pick from here. Yeah, you pick from here. Twende nayo mpaka hapa wewe. Mpaka hapo. Close the brackets. Enter. This one we had already gotten earlier. But now we can give it top double, bottom. And then autofill this. Rudi kwenye umetoka. Tembelea hapa. Yeah. Ndio sasa tukiendelea kujaza, ziende zikijipanga. Na hii imekuwa kubwa sana. This one for the adjusted balances. This one ilifaa kubalance. Ifaa kubalance, kwani there is something we did not include. The adjustments. Oh, ni hii. Naona hii. Hii the closing inventory. This one that is going to the nilifanya makosa. Nili credit badala ya kudebit. Sasa hizi zimekosewa zote. Because hizi ndio column, nafaa kuangalia sana column zako. So hizi nimeziweka vibaya. So closing inventory should be credited. So I should have said equals 43,150 hapo. Sasa kwanza hizi nitoe. Hata hii nitoe. So closing inventory that is going to the P&L, we should credit. Alafu nikuje sasa hapa niweke kwa credit. Alafu the one going to the statement of financial position I should debit. And then ikuja hapa ikuwe debited kwa statement of financial position. Now with that, the adjustments should agree. Yes. The adjustments should balance. From there, let's now ensure that everything is fully completed. Tukianza hapa kwa ordinary share capital, we began with 60,000. There was an adjustment of 5. So this one should come here as this 60 plus this 5. The 60 plus 5 should come in there as 65. Preference share capital was 20,000, no adjustment, and therefore it should find its way here the way it was, 20. Revaluation, we began with 12. We adjusted with a credit of 4. So we should close here with a credit of 12 plus 4. $12 plus 4. So closing inventory nilikuwa nimesema inafaa kuwa credited. This one inafaa kuwa credited kwa statement of profit or loss. Because itakuwa negative. Ukiangalia how we do it pale, inakuanga ukishaweka opening stock, purchases, less closing. Ndio tunaiweka credit. Alafu you debit here because it is a current asset. It's a current asset. That's why we are debiting here. Alafu naileta kwa statement of financial position. Alafu sasa hii inakuwa kwa credit of statement of profit or loss. Is that okay, Kevin? Good. So, tulikuwa tumefika hapa. Revaluation tumemaliza. Retained earnings, no adjustment. So, tuilete tu ikiwa hivyo. Opening inventory, this one only goes to the statement of profit or loss here. as a debit amount, it does not go to the statement of financial position. Trade receivables, we opened with a debit of 17, no adjustment, so it should come here as a debit of 17,600. Now cash and bank assets 89, no adjustments. Trade payables, no adjustment, so it comes in here as a credit. Loan stock, no adjustment, ikuje hapa ikiwa credit. Sales should go to the credit of P&L. Sales, credit of P&L. Haya. Tukuje kwa purchases. Purchases, I have to debit that because an expense. Credit loss, that is an expense, so we debit. Salaries, those are expenses. But as you can see, there was an adjustment, a debit. So this debit must have been an accrual. So we are going to say 11,100 plus this 520. We add. Insurance, no adjustment, so it comes in here. For P&L, that is an expense. Postage, the same. Writing, the same. Roll stock, we are going to add because we had 400 here and we debited some other 400. Directors emoluments, we should also debit them in the income. Dividends paid, the same story. The dividends paid preference, the same story. General expenses, we began with 4590. Then we subtract this 350. Press enter and tell me what you're going to get. 4590, you minus the prepayment. Tell me what you're getting. So if that is what you're getting, higher motor vehicles at costs. That's an asset. We debit there. Accumulated depreciation, it was adjusted. So we will say equals, you take this 63 plus this 40. Na iende kwa credit. We come to office, the same thing. Accumulated depreciation, the same. This 86 plus this 32. LAD, the same. LAD was revalued upwards. LAD. So it is this 25 plus this 4,000. The 25,000 plus 4,000. Buildings. Accumulated depreciation equals this plus this. Suspense account hii ilikuwa imeisha. Suspense account is not there now. Yeah, so I think we have dealt with everything because sasa hizi zingine kuanzia hapa hizi tulikuwa tunapeleka mpaka mwisho. So with that now you can see we have a profit because the credits here are more. 363. So hiyo itakuja hapa. Kuja hapa tuseme equals the sum. Kwanza uchukue hizi za credit, uanzie hapa. Ukibie nayo juu. Mpaka hapo. Close the brackets. Then you minus sum. I cannot. Now sum nitachukua kuanzia hapa mpaka hii. Hiyo ya 104. Close the brackets, press enter, niambie how much you are getting. Enter, uniambie how much. So when I enter, I'm getting that, na hiyo ina balance. Alafu sasa hiyo nikuje niweke hapa. Equals this. And you can see our books now are balanced. Any question? So if there is no question, then we bring our lesson at the end, to the end at that point. We bring our lesson to the end. At that point, then I forgot to mark the register. Let me take a photo of this. I will mark later. So thank you very much. See you now next time to pick up from there.